probably the easiest and most efficient way to invest in gold is to buy an exchange-traded fund or ETF that invests in gold bullion. While we're not recommending and we don't own any of these funds, we've listed a few of the more popular gold ETFs for your reference and for you to look into more. Now, these funds own actual gold bullion, and you can buy and sell them in real time on an exchange, just like a stock. You'll pay your normal equity commission with whatever broker you're with, plus a management fee to the management company of the ETFs, just like you would with a mutual fund. The management fees on these particular ETFs range from 25 to 40 basis points. So it's a relatively cost-effective, liquid, and efficient way to own physical gold. Lastly here, before we wrap up, it's really important for any gold investor to know that sales of gold are treated differently for tax purposes when it comes to long-term capital gains. Gold is actually treated as a collectible, which carries a maximum federal long-term capital gains rate of 28%. For other investments that aren't deemed collectible, the maximum federal long-term capital gains rate is 15%. So gold is at a disadvantage to other investments when it comes to long-term capital gains. And this applies whether you own the gold yourself or whether it's held through an ETF.
Thank you very much, Matt. We have some questions coming in, so we'll get to those in just a minute. If you haven't submitted your question yet, please do it now, and we'll make sure that we answer that. Most of our webinars are available on our website, while others, for compliance reasons, are available in the Client Resources section of our website. A recorded version of today's webinar will be available in approximately 1 week, and you will receive notification via email when it's available. Our next webinar is already scheduled for April 20th at 2 o'clock. The subject is going to be building momentum through financial planning. We'd like to remind you that you are going to receive a survey soon after we log off here. Again, we really value your responses and comments. That's how we chose the topic for today's webinar in the questions we were getting about gold. So please fill out that survey, and we'll value that very highly. Okay, we do have some questions. We're done with the formal part of the presentation. And so, Matt, where would you like to start here?
The first question we have is, how much gold should an investor allocate to their portfolio? Well, each individual investor is obviously different, so I'm going to come at that from a broad general sense. So from that perspective, we wouldn't advise allocating much more than 5–10% of your portfolio to gold. As I think we've shown, gold involves some fairly significant risks, and it would be an undiversified investment because you're only investing in one particular commodity. So we wouldn't advise investing 20% of your portfolio in oil or IBM stock. So the same type of prudent diversification limits definitely apply to gold. But you should be out to diversify your currency exposure. And as we said, gold is an alternative currency, so it can play a role in that.
All right, good. We have some more questions coming in. The second one here is, what do your momentum indicators currently say about gold?
Gold has good momentum. It has strong positive momentum and has had some for some time. I'm sure most of you can tell that by looking at the price chart we showed early in the presentation. So we do have exposure to gold in some of the funds that we're using for some of our clients, but we're actually seeing superior momentum and better value in gold mining stocks. Gold mining stocks are much easier to value than the price of gold, so we can be a little bit more confident that we're getting into an asset with good momentum and undervalued fundamentals when it comes to gold mining stocks. So our exposure to mining companies actually exceeds our exposure to gold currently. Another question we have here is, what is the ETF holding as an asset? Is it holding gold itself or futures or other contracts? The bulk of the ETF's holdings are actually physical gold, but obviously with an ETF, they have investor cash flows to deal with. Money is coming in and money is coming out, so they do supplement that with futures to help them manage their cash flows. Lastly here, I think we have time for one more question. If I buy gold bullion through an ETF, are my gains still taxed as a collectible, or are they taxed as capital gains? We actually got a couple different questions regarding this one. You don't get around the collectible tax by holding gold in an ETF. As it states in all of their prospectuses, if you read them, is that the gains on the sale of the ETF that hold gold bullion are taxed as a collectible, just as if you own the bullion yourself.
Thank you very much for logging in today. If we didn't answer your question, we will get back to you specifically about your particular question. Please stay in touch with us at Bell Investment Advisors. Visit our new interactive website, bellinvest.com. Follow us on Twitter at BellInvest. And check out Bonnie Bell's career and life coaching blog at careerlifecoaching.bellinvest.com. That's been a very popular blog, and we're happy to see that. You have our email address on the screen and, of course, our phone numbers. We always look forward to hearing from you, and we use the comments and information that you send to us to help design future presentations. Hope you have an enjoyable afternoon. Thank you.